With Chapter 10, we finish off our coverage of insurance, focusing on life insurance and where it fits in your financial plan. As usual, we begin with our learning objectives for the chapter. Number 1, define life insurance and determine your life insurance needs. Number 2, distinguish between the types of life insurance companies and analyze various types of life insurance policies these companies issue. Number 3, select important provisions in life insurance contracts and create a plan to buy life insurance. And 4, recognize how annuities provide financial security. So, exactly what is life insurance? Basically, you purchase a policy and pay premiums over time so that the insurance company will pay out to your beneficiary at your death. Not a happy topic to consider your own death. Contemplating your own death is not a happy subject, but the purpose of life insurance is to protect someone who depends on you financially. Other possible uses for life insurance are listed on the slide. Beyond providing funds for your survivors to pay off a mortgage or establish a steady income or lifetime income for children, life insurance benefits could be used for charitable contributions. The basic principle of life insurance is risk pooling. The mortality tables in Exhibit 10.1 in your text give the expected life expectancy as of 2012 for men and women. Based on tables such as these, insurance companies estimate the odds of a policyholder dying within a certain number of years. As should probably be obvious, the younger you are when you buy a policy, the lower the premium, since the odds of you dying are low. As you age, the premiums go up. Most likely, you'll live longer than your ancestors. In 1900, an American male's life expectancy was 46.3 years. In 2012, a male was expected to live until 76.4 and a female until 81.2. As has always been the case, females tend to outlive males. The real question is, do you need life insurance? If you're single, without a lot of debt, and no one depending on you for financial support, maybe not. Perhaps even though you don't need life insurance, you'd like to leave a bequest to a charity, or you want to be sure your parents are provided for should anything happen to you. Once you have a family of your own, that all changes. Many young adults don't consider life insurance until they're married with children. Then the reality of what would happen if anything happened to them sinks in, and life insurance takes on new importance. The text outlines 4 methods of determining the amount of life insurance you may need. The first 2 are on this slide. The easy method, assuming a typical family, 70% of your salary for 7 years while your family adjusts to the loss. This may not be appropriate for you, but it'll give you a starting point. The DINK method is for dual income couples with no kids. The method assumes the spouse's incomes are about equal. Life insurance should cover funeral expenses plus half of all outstanding debts. Note that the average funeral in America today runs $7,000 to $10,000. The third method is the non-working spouse method. Life insurance should cover the number of years until the youngest child reaches 18 times $10,000. The $10,000 could be reduced if some of the children are teenagers. It should be increased if there are special needs. The final method is called family need. This is the most thorough and detailed method. The other 3 methods assume you and your family are typical, which may not be the case. Specific consideration is given to all potential sources of income via insurance, Social Security, assets, etc. You need to consider which method is most appropriate for your circumstances and use the resulting figure as a starting point in looking for life insurance coverage. When looking for insurance, you'll be presented with 2 types of insurance companies, stock life and mutual life. Stock life insurance companies are the most common. These are companies owned by the shareholders. Stock life policies are called non-par or non-participating. Mutual life insurance companies are owned by the policyholders. Policies are considered participating. The debate over which is better has resulted in no clear-cut answers. Both offer benefits based on your needs. Stock life insurance companies are the most common, representing 73% of life insurance companies. These are companies owned by shareholders. Stock life policies are called non-par or non-participating. If you want to pay the same premium, choose a non-par policy. Mutual life insurance companies are owned by the policyholders. 27% of life insurance companies are of this type. Policies are considered participating. Premiums tend to be a bit higher than non-par, but policyholders receive refunds called policy dividends. Now that we've looked at insurance companies, let's consider all the different types of policies available. We'll look at each of these types in more depth on the following slides. Term life is basically temporary insurance. It protects the policyholder for a specified time period. You stop paying the premium, policy ends. Term life is relatively inexpensive for young adults in good health, so many start with term life. Many employers also offer term life for a certain multiple of your base salary as part of your compensation package. A renewable option allows a term life policy to be renewed for a similar period, but at a higher premium as you're now older. Multi-year level is the most popular, assuring you will pay the same premium for the life of the coverage. A conversion term allows you to convert to whole life with a higher premium. Decreasing term pays less as time passes, perhaps suitable as coverage for a mortgage that's decreasing over time. Return of premium pays all premiums back to the policyholder if they survive to the end of the term. Whole life insurance is considered straight life. You pay the premium as long as you live. The premium depends on your age when you take out the policy, an incentive to start young. The policy provides death benefits. It also accumulates a cash value that you can borrow against. Be careful of a low rate of return on whole life. Remember, the purpose of life insurance is not for investment. Whole life policies have a range of options. The limited payment policy allows the holder to pay premiums for a specified length of time, usually 20 to 30 years, after which the policy is considered paid up and remains in effect with no future payments required. With a variable life policy, your premiums are fixed, but part of that premium is invested. The death benefit is guaranteed, but the cash value varies with market values in the investment portion. Adjustable life allows you to change the policy while it's in effect, changing the term, the death benefit, or the premium. Universal life is a whole life policy that combines term life and investments. You can change your premium amount without changing your coverage. As with a variable life, a portion of your premium goes in an investment account, which impacts the cash value of your policy. Group life insurance is, as I mentioned, term insurance frequently offered as part of your employer's benefit package. The beauty of group life is that no physical is required as long as you elect the coverage at the time you're hired. Credit life guarantees the payoff of a loan if the borrower dies. Credit life is typically used for mortgages or cars, but it can be quite expensive. Endowment life provides coverage for a specified period of time and pays the policyholder if they survive to the end of the term. This is the top part of Exhibit 10.3 on page 326. It recaps the basics for the three major types of life insurance policies: whole life, term life, universal life. Using this chart can help you determine what type of policy will fit your needs. Pay particular attention to the advantages and disadvantages. This is the remainder of Exhibit 10.3 comparing the three types of life insurance policies. Our third learning objective moves us along to choosing the options available with a life insurance policy. You must name a primary beneficiary who will receive the funds when the policy pays off. You can also name contingent beneficiaries should the primary beneficiary predecease you. These should be reviewed and updated periodically. An incontestability clause usually states that the company cannot cancel the policy after it's been in effect for a specified period, usually 2 years, even if the policy was obtained through fraud. You need to be aware of the grace period for late payments. You do not want your policy to lapse due to non-payment. Finally, you need to be aware of the policy for reinstating a lapsed policy if it's not been turned in for cash value. Continuing with key provisions in life insurance policies. A non-forfeiture clause means you retain the cash value if you survive to the end of the policy. Misstatement of age covers a situation where the insurance company finds out you misstated your age, basically obtaining more coverage than your true age would provide for the money. The company will pay benefits that your premium would have bought had you told the truth about your age. A policy loan provision allows you to borrow against the cash value of a whole life policy. If not repaid, this reduces the death benefit. Most of us who have watched any TV or movies know that insurance doesn't pay off for suicide within the first 2 years of the policy. A policy rider adds to or changes the benefits in a policy. Policy riders can take many forms. A waiver of disability benefits allows you to stop paying premiums if you're totally or permanently disabled. Again, from the TV and movies, double indemnity pays double the policy benefit if the holder dies in an accident. Generally, there's an age limit on this, typically 60 or 65, after which it's invalid. Guaranteed insurability allows you to buy additional insurance at certain intervals without having a physical. Cost of living protection helps prevent inflation from eroding your policy protection. See Exhibit 10.4 on page 329 for a graphic of the effects of inflation on a $100,000 policy over 20 years. Accelerated benefits are also called living benefits and are paid to a holder who is terminally ill before they die. A second-to-die option insures two people, usually a husband and wife, with the benefits paid after the second insured dies. We've covered a lot about life insurance, and there's a lot to consider when deciding on coverage. What are your present and future sources of income? What other savings and income protection do you have? Do you have group life insurance through your employer? What annuities or pension benefits do you have? Consider your Social Security benefits. Importantly, consider the financial strength of the insurance company itself. It needs to be financially strong to be around for 30 to 50 years. There are many sources for information on insurance companies. Companies are rated by several rating agencies, including AM Best, Standard & Poor's, and Duff & Phelps, Moody's, and Weiss Research, as you can see in Exhibit 10.5 on page 330 in your text. Do your online research, but also ask family and friends for their recommendations as well. As suggested, talk to your family members and friends. You need to be comfortable with your choice of an agent. You're looking at buying a product that will have a 20-plus year term. Is the agent available when you need them? Does the agent ask about your financial plan? Do you feel pressured? If so, leave. Is the agent current? Look for one with a CLU, Certified Life Underwriter designation. CLUs are required to take continuing education every year to stay current with industry changes. Will the agent take time to answer your questions and help you find the right policy for your needs? It's a lot to consider. When looking at policy specifics, of course, you need to compare the costs. The cost of a policy to you will be determined by several factors. The company's cost of doing business, how well the company's investments are performing, the mortality rate of policyholders, meaning the company's having to pay off a lot. What features do they offer in their policies? What about competition? Ask your potential agent for interest-adjusted indexes, which is a method for evaluating the cost of life insurance considering the time value of money. The lower the index value, the lower the cost of the policy. Once you decide on an agent and a type of policy, your next step is to apply for coverage. Unless this is a group policy, you'll be required to provide a medical history and possibly have a physical examination by a company doctor. Read every word of the policy contract. Do not sign it if there's anything you don't understand. Even after signing, you have a 10-day grace period to change your mind. Once in place, give a copy to your lawyer and your beneficiary. Life insurance benefits can be paid out in several ways, though lump sum is by far the most common. Payments may be made in equal installments over a specified number of years. A life income option can be set up to provide lifetime income for the beneficiary. Of course, the proceeds can be left with the company with interest paid to the beneficiary. What if you decide you don't have the right coverage? Should you switch? Think twice. It could be costly. Are you still insurable? Premiums will be higher as you're older now. Is the change worth it to get the options you want? Our final topic is using annuities in your financial plan. An annuity is a financial contract, frequently written by an insurance company that pays regular income. As the slide states, this can be used to supplement retirement income and shelter income from taxes. Annuities work best for those who expect to live longer than average. Before even considering an annuity, you should fully fund all available retirement plan options, IRAs and 401ks. If you do decide an annuity might be right for you, it can provide retirement income for life. Consider the time value of money. The interest grows tax-free until you withdraw it. Unlike an IRA, there is no limit on the amount you can contribute or use to set up an annuity. But note that the beneficiary is guaranteed no less than the amount paid in. Preservation of capital. As with most financial assets, there are a variety of types. An immediate annuity begins payments immediately. A deferred annuity begins payments at a chosen point in the future. An index annuity has an earnings rate based on a specified stock market index, such as the S&P 500. A fixed annuity fixes the amount paid, while a variable annuity bases payments on the investment results underlying the annuity. All annuities can be included in IRAs and Keogh plans. Annuities are long-term investments. There will be a surrender charge if the funds are withdrawn within a certain time period, usually 6 to 8 years. The mortality and risk charge is usually 1.25% of your account value and covers the firm's risk. Administrative fees cover the insurance company's cost of doing business. It may be charged as a flat $25 or $30 a year or as a percentage of your account value, usually 0.15% per year. Finally, the fund's expenses cover the fees charged by the mutual funds underlying a variable annuity. The Tax Reform Act of 1986 specified that interest on both the principal and interest for annuities and insurance build up tax-free. Deductions for IRAs were, however, ended. With annuities, there is no limit on annual contributions, and beneficiaries are guaranteed no less than the amount contributed. On the downside, annuities do not tend to generate high rates of return, and once started, they're relatively inflexible. That finished Chapter 10 and our coverage of insurance. Our first objective covered definitions of life insurance and methods of determining your needs. Objective 2 detailed the types of insurance companies and insurance policies. Objective 3 covered the important provisions of life insurance policies. And Objective 4 covers annuities and how they fit in a financial plan.